Let us look at the capital asset pricing model for calculating the cost of equity. So the capital asset pricing model is a financial formula that calculates a company's cost of equity based on its systematic risk covered by beta, the risk-free rate of return, and the overall market's expected return. The formula is displayed on screen, which is the risk-free rate of return plus the beta factor multiplied by the risk premium. The risk premium being the expected return on the market less the risk-free rate of return represented by the E open brackets RM minus RF in brackets in the formula. Let's apply the formula to an illustrative example. The scenario requires us to determine the cost of equity on the basis of the cost of debt at 5%, beta factor of 1,2, and the expected return on the market of 7%. To calculate the cost of equity by applying the capital asset pricing model formula, firstly, let's determine the variables. Firstly, the risk-free rate of return used will be the cost of debt, 5%. The beta factor will be 1,2, and the expected return to determine the risk premium is given at 7%. If we multiply the 1,2 by the risk premium of 2% obtained by subtracting 5% from 7%, we get 2,4%. The 2,4% added to the risk-free rate of return, 5%, will give us 7,4%. And this will be our cost of equity. The first assumption under the capital asset pricing model is that the investor holds a diversified investment portfolio to eliminate what is referred to unsystematic risk. The second assumption is that the beta factor covers the systematic risk and it measures the price volatility. Third is the assumption that a risk-free rate of return exists, normally represented by the cost of debt. Finally, the capital asset pricing model is based on existence of a perfect market where there are no taxes, transaction costs, or inflation. The beta factor measures the systematic risk, indicating the price volatility or the price sensitivity compared to the overall market. If the beta equals 1, this represents that the price moves with the market. If the beta exceeds 1, this shows that the price is more volatile, indicating a higher risk or a return. If the beta falls below 1, this shows the price is less volatile, indicating a lower risk or return. The beta factor is categorized into two: the equity beta and the asset beta. The equity beta, referred to as the geared beta or levered beta, shows the volatility of a company's stock returns relative to the market. It includes both business risk and financial risk. The asset beta, referred to as the ungeared beta or unlevered beta, is the beta of a company assuming non-existence of debt. It includes only the inherent business risk, stripping out financial leverage. The key relationship between the two is that the equity beta includes both business risk and financial risk, whereas the asset beta isolates only the business risk of the underlying assets, with higher debt amplifying equity beta. In simpler terms, the relationship shows how much debt magnifies equity risk. meaning as a company takes on more debt, its equity beta rises above its asset beta because equity holders bear more risk. Let us look at the difference between systematic risk and unsystematic risk. The unsystematic risk is the risk unique to a single company or industry. For example, management issues, returns of goods, etc. Whereas systematic risk includes the risk that is inherent to the entire market, such as economic recessions, inflation or interest rate changes, and political issues. Under the capital asset pricing model, it is assumed that the unsystematic risk can be reduced to an acceptable level by holding a diversified portfolio. As systematic risk is one that is inherent to the entire market, this can't be eliminated by diversification.